Hello everybody, welcome to Rachel's classroom. In this video, we will be discussing two more methods of calculating cost of equity capital. In the earlier video, we saw how to calculate cost of equity capital using dividend yield or dividend price method. In this video, we will be seeing two more methods. The first method being dividend yield plus growth method. In this method, the cost of equity is determined on the basis of the expected dividend rate plus the rate of growth in dividend. The growth rate in dividend is assumed to be equal to the growth rate in earnings per share and market price per share. So here again we will be using two formulae based on the kind of shares that is being discussed. If it is in the case of new shares, we will use expected dividends divided by net proceeds plus growth rate. In the case of existing shares, we will be using dividends divided by market price plus growth. So let's see an example sum. Okay, here we have a sum. The market price of an equity share of a company is rupees 120. The expected equity dividend is 2.40 paise. The shareholders anticipate a growth of 10% in dividends. We are expected to calculate the cost of equity capital. Let's solve this problem. So the market price is MP is 120, dividend is 2.40, G growth is 10%. Simply we have to substitute the values onto the formula and find the percentage. First we find the percentage for D1 by MP and then we add it to the growth percentage. So the cost of equity is 12%. Now let's move on to the next method. In this method, earnings per price method is based on the expected rate of earnings of the firm. So here again we will be using two formulas. First we need to find the earnings per share and then divided by net proceeds or market price depending on whether it is a new share or an existing share. Let's move on to the example. A company earns a profit after tax of rupees 7,50,000. Profit after tax can be referred to as earnings after tax also. So the company has 1 lakh shares outstanding and the current market price per share is rupees 120. The earnings are expected to remain stable and the payout is 100%. So there are two scenarios. The first scenario is they are asking us to calculate the cost of equity capital for the current scenario. Second scenario is what will be the cost of equity capital if the payout ratio goes down to 60% and the company earns 12% on its investments. So let's take one scenario at a time and let's proceed. So let's start with earnings after tax, EAT, which is 7,50,000. Number of shares is 1 lakh. So the formula for earnings per share is earnings after tax divided by number of equity shares. So EPS is 7.5 and MP is already given 120. So it's pretty straightforward. 7.5 divided by 120 into 100, we get cost of equity as 6.25%. Now let's move on to the second part of the problem. In the first part of the problem, it was assumed that the payout is 100%. So for pay 100% payout, the earnings per share was 7.5%. So we have to find out what will be the EPS when the payout is 60%. So 60% of 7.5 is 4.5 and market price being 120. Growth is 12% on 40%. 40% is the amount that is being retained. That is of the 100, 60 they are giving away as dividend. The 40 only they are pulling it back into the business. So that is what is contributing to the growth. So that's why we are calculating 12% on 40%. So 12 divided by 100 into 40 is 4.8%. We will be using the dividend yield plus growth formula. So 4.5 is the dividend divided by market price 120 into 100 plus growth is 4.8%. So therefore, for the cost of equity for the second scenario is 8.55%. Thank you.